Hi, Joe Cantu here. A weak U.S. dollar. What are some of the best investments to use in your portfolio from a historical standpoint?
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
A weak U.S. dollar. What are some of the best investments to use in your portfolio from a historical standpoint? Okay, so what we're going to talk about is 3 topics primarily. Number 1, the causes of a weak U.S. dollar. Number 2, hidden truths on the way to combat a weak U.S. dollar in the fixed income area, the bond area. And number 3, how to combat a weak U.S. dollar in the stock area. So let's get started. So obviously, let's just talk about some of the causes of a weak U.S. dollar. Very simply, inflation. It takes more money to purchase the same amount of goods, so in essence, your dollar is worth less. Very simple concept. And we have high inflation here in the United States. But in any country, if you have high inflation, your dollar value is falling in terms of buying power. Obviously, also, other countries could lose confidence in your country's currency. Did that ever happen in the United States? Yes. If you remember, in 2012, we had the fiscal cliff. I mean, it got all the way, Congress and the president couldn't agree. I think President Obama waited until the 2nd of January to sign the agreement for us to pay our bills. And that was called the fiscal cliff. And so, had we not paid our debt, then other countries lose confidence, and the value, it weakens the U.S. dollar. And that is, in fact, what happened here in the United States, as a matter of fact, is that a lot of people lost confidence. To tell you a quick story, I have a neighbor next door, and she's from St. Kitts. Here, when I was living in Miami, I live in Fort Lauderdale now. But anyway, her son runs a grocery store and several other businesses on St. Kitts. But he said most of the vendors in all the islands during this time, they wouldn't take U.S. dollars anymore. They would only take gold. So the U.S. Gold Eagle. They would only take gold to pay for the goods and services from anyone in the United States because they didn't trust the U.S. currency. So that caused a weak dollar. But that happens in any country. That can happen in any country if they just lose confidence in the fact that a sovereignty or a leadership will not be able to pay its debt. So all of a sudden their paper, the money that you use becomes worthless or worth less, let's just say. Also, let's talk about goods and manufacturing. If a country is shipping goods to another country and they're of poor quality, that can also cause a weak dollar. And then lastly, the country that you're using to purchase your dollars, you wonder if the buying power of that dollar is still going to be worth something in the future. And if you feel that it isn't, then that obviously weakens that particular currency as well. So now let's talk about the best investments to use to combat, in this case, a weak U.S. dollar. And we're going to talk about fixed income. And the name of my podcast is Hidden Truths about investing in retirement. Well, this is a small little hidden truth. But you can use international bonds to make money with a weak dollar. Let me say that again. You can use international bonds to make money with a weak dollar. How do you do that? So it's not as simple as calling up your financial planner, calling up your broker, and saying, hey, go put an international bond fund inside my investment portfolio, and then you look at it a year later, and you haven't made any money. It hadn't gone up in value. Why? Well, here's the hidden truth to it, that the bonds have to be in the foreign local currency, not in US dollars. So if you actually called your financial planner, called your broker, and said, put an international bond fund in my investment portfolio, he would go put an international bond fund in your investment portfolio. The problem with that is he did it in US dollars. So you have to specifically request foreign currencies or local currency, quote, local currency bond funds if you want to use that. Now, but let me kind of give you an example of what's happening in real life. Now pardon my head turn just a little bit, but I'm going to pull this chart over here and explain it, give you a real world example. So let's see if we can see this chart here. So in this particular case, and for those listening on the podcast, I have a chart and I have three separate lines on the chart. One is the US dollar. It's actually the euro against the US dollar. I have the S&P 500 in a green line, the euro and US dollars in blue line, and then I have a local currency bond ETF, exchange traded fund, on the chart. And what it shows on this chart, if you actually look at it, so the green line is the stock market. It's going up. Boom. This is actually the 23rd, the 21st, the 22nd, the 23rd, the 24th, and the 25th. But it shows the stock market going down, and then it kind of wanders off here. And then you have the US dollar right here in blue, euro against the US. And this yellow line is actually a exchange traded fund, bond fund, in local currencies. It's in the currency of those countries, not in US dollars. And look at it. That yellow line is higher than the blue line, it's higher than the green line, higher than the stock market, and it's just kind of taken off. Why is it taken off? It's taken off because we have a weak US dollar here in the United States. But that's kind of a real world example of, and I'm not recommending these particular securities, I'm just showing this to you as an example of how to use them in the portfolio. In other words, there is a way to go to put these in here. Now let's talk about the actual price of these things. So that particular ETF was trading at about $33, and the yield on it is about 7.3%. Now I will tell you that's normally unusual. Most yields on local currency bond ETFs are between 3 to 5%, but because the stock market has pulled back globally, then they're down about 20%. This particular yield is about 7.3%. But let's say over the year that this bond, this fixed income investment, this bond ETF, traded at $35. So in 1 year, it went up $2 a share. $2 a share. Or two, going backwards. So anyway, so that's a 6% gain. Now, why would it do that? It would do that because the US, the dollar, is going down in value and the foreign currencies are going up. And that adds to the price difference of the actual investment itself. And that price difference, in this particular example, is gone up $2 a share from $33 to $35 in my hypothetical example. It's made a 6% gain. But that's not the best part. The best part is you still get the dividend of 7.3%. So now you get 7.3% plus 6%. You made 13.3%. That's a pretty good return, and you're not even in the stock market. That's 13.3% gain in 1 year, and you're not even in the stock market, and you made money just because we had a weak US dollar. So, and that really happens. And just for disclosure reasons, we do own local currency bonds in in some of our investment portfolios, not in all the portfolios. All right, now let's move over to the equity side of the picture. So a lot of people believe, okay, well, because of this inflation, there's a problem, and what about stocks? You know, how does it affect stocks? Okay, so let's talk about it. So we have two major types of stocks, and let's talk about two different types of companies. We have a company that's strictly in the U.S. and it only sells to U.S. patrons. We have another company that's a multinational company, and it sells products overseas. So what's a good example of that? Okay, so say one example would be a company that only sells in the United States. Now another company, say Caterpillar, for example, I'm not recommending the stock, just using that as an example. Procter & Gamble is another example. So these companies, they sell products outside the United States. So now think about that. So when they sell in foreign countries, if the US dollar goes down against their sales that they made in the foreign country, and then they get those earnings and they have to report them in US dollars, then in essence that helps their earnings report, because they made money because of a weak dollar, because the money they made was in foreign currencies. So as a result, stocks, so multinational companies that have a multinational sales, have some degree of insulation and actually benefit from a weak dollar. That's interesting, right? Just because of a weak dollar, they actually benefit from their foreign sales. So now you've learned that a weak dollar isn't necessarily negative, but another way to say it is stocks can be an insulation for your portfolio if the stocks are multinational companies, if they sell goods and services around the world. For example, like Coca-Cola. Example. Now I have to disclose that we do own Coca-Cola in the portfolios. Again, not all of them, but some of the portfolios. But that's a good example of a multinational company that gets earnings from foreign entities, and then as a result, their earnings actually benefit. They actually benefit from a weak dollar when they're reporting earnings. Anyway, that concludes this presentation on the best investments to use historically in a weak U.S. dollar situation. If you have any questions, give us a call.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management is a fiduciary, registered investment advisory firm in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.